Well, we're going to jump right into it. Welcome to our 71st OPN event. Today it is Ask an Angel, and this is going to be our first time running this segment. So we're pretty excited about it, and we will accept all questions. So please feel free to post your questions below, and then I'm going to bring Laura in as we go, and we're going to dialogue about these questions. We've got lots of them, which is great. So we're looking forward to chatting with everybody. So feel free to post as we go. Let's jump right into it. I'm going to turn Laura on, and you are now unmuted, Laura.
Hello. So a good question to start off with COVID right now. Tanya's asking, in general, could you start by telling us a bit about angel investing and how it's been affected by COVID?
For sure. Great question. And based on the timing that we're in, because it's relatively, say, new in the system of where we're going, it is only, I guess, the last month where everything has shifted significantly, and the impact has been quite significant. So where we're seeing things right now is that there has been some pullback. I wouldn't say that it's been dropped off and that there isn't anybody investing. But what has occurred is that people are taking a sidestep to see where the lay of the land is going to be. Of course, there's a lot of components in this space, different sectors that have been shut down, different areas that have been more affected than others. But in the angel and VC world, we're continuing to move all of our events forward. So in all of the groups that we're part of, some have shut down for the month of March and are picking back up again in May. Others have continued to push forward, and investments are still happening. They're just probably not working at the same significant level that they were. And I mean by that is that if an angel group was investing $500,000, they may now only be investing $250,000. So there's just been a slight reduction in people obviously monitoring what's going on, protecting the area, but investing is still happening. It's just taking a bit of a slower pace, which means that you're going to have to start looking at different ways to get out in front of more people, to pitch at a lot more angles, I guess, if you will. But you're going to have to really dive in deep in order to make sure that you've got a great business that can get picked up and get investment. But angels are hungry. They do want to invest, and they will. It just means the startups are going to have to start looking at sharpening their tools and maybe coming back with a better value add in order to drive people into their business.
Okay, great. Michaud, I hope I said that right. He's asking, what role do investors play in developing the leadership capacities of the founders they fund?
Another great question. So I think, and to iterate on that, is that a lot of companies, when they first start out, there's only a few people that will be in that company. And the key to a lot of things that go on in an early stage company is that you're just trying to vie for position, pole position in a space. So you may only have 1 or 2, 3 or 4 people on your team. And to de-risk it, investors are always looking at type of board of advisors that you have, board of directors. And even though some of these might be too early for you, some of them are going to also be able to build some of that traction for you. So in order to build the leadership, it's got to come from the top. And how do you build a great leadership at the top if this is your first time running a business? And the great way around that is that you need to find somebody that is more senior to yourself and ask them to be a mentor. These people will be able to guide you through the ecosystem, guide you through any of the problems that you may face. And it's a good sounding board for you to have somebody that's close to you that you can talk with. And does that mean that you want somebody that's completely out of your space when you're starting a company? Sometimes yes, because they're going to give you a different viewpoint into what you're trying to build and grow. So that might mean that you might need 2 mentors. One that is really proficient and well-known in the space that you're in. So if you're in hospitality, find somebody that has maybe retired or a senior level person that has run through the systems. And that way you'll be able to get their feedback and be able to soundbite off them what you're looking to do, the pieces you'd like to change and modify, because you're trying to solve a problem and they may have faced that problem. So they're going to be able to give you a lot of great insights on how to move forward. Now, having somebody on the opposite spectrum, maybe in CPG, they might be able to provide you with different insights into how you can help in this healthcare space or in other areas that you may not have thought of. And all of these little pieces are going to help you stay focused and be able to troubleshoot to move forward. So working on your leadership, find a few mentors that can help you. And then of course, build on a board. Try to find some people that will support and get behind your business, because that helps de-risk it. And then as you continue to grow, those people will shift because the knowledge base is going to shift as well.
Okay, perfect. Lauren is wondering how you think brands can show projected growth now with the unpredictability of the current climate. We know it's not a great time to approach retailers for new SKUs or new retailers for listings.
That's another great question. All right, on the hot seat. So this is good. So when it comes to retailers and positioning right now, there are categories that are looking for a lot of products. Grocery retailers are trying to keep their shelf space filled. They are reaching out and looking for people that can help solve that problem. You just need to really dig in and find people that can support you. Find ways to get into that space so that you can adjust and provide them with the products they're looking for. If you're looking at retail stores, if it's in the clothing space, they're going to have online businesses. There's different online platforms that can support your product and help you get into that space as well. You have Amazon. There's plenty of online e-commerce platforms that can support your products. They're looking for new products. Right now, there is a big shift, obviously, from retail to online. And how do you do that? How do you get showtime? How do you get people to believe in what you're doing? There's a lot of different tactics that you can do. A lot of our startups have done online campaign programs to build exposure around their product. But if there's a need and people are looking to fill that need, 100%, they're going to try and pick up your product. You have to find the value conversion. People are looking for different sectors. From obviously in healthcare, you have masks, you have clothing products. There's a lot of different pieces inside of that space that can be fed. But then on the other end, people at home are looking for different aspects too. They're looking for food, things for their kids to do, things for the family to do. So there's a lot of things that you can shift to in order to grab some of that attention. And at this point, everybody's going to be shifting as much as they can to find different products to sell, because they want to make sure that they're accommodating their clientele as they come into their business. So you have to really start to dig in, look at Gwyneth Paltrow's business online. There's so many places where they're looking for good products, and you have to find a way to catch their attention. And those ways can come from your own marketing, getting some sort of celebrity support, or pitching everywhere and getting picked up because people start to see the value of your product and how it's enhancing someone else's experience, or how you're supporting, say, kids at home or education at home, whatever that might be. But you have to start to think about, if we're in this space for the next 3 to 6 months and we're all working from home, we're all educating from home, what can my product do inside of that space? And then how can I drive attention to it enough so that it'll allow me to work my way through this? And we've had lots of our startups have to pivot and change from doing on-site products to shifting to online and selling their product to support currently where they're at. And then where they're planning is, where am I going to be in 6 months so that I can start to work towards that? But keep in mind that throughout all of this, everybody is looking to figure out how they can find new products to get online to sell, because there are shortages of a lot of great things.
Okay, great. So I'm trying to generalize some of these questions so they're not specific to one person, but can help everyone. So on resourcing questions, I think if you're looking for a resource, I think it would be fantastic to sign up for one of our Thursday shows, because that's the whole purpose of that, is to get help from everybody on wherever you might need help. A good question is, when is the right time to give up any equity when starting a tech company?
Okay, so when is it the right time to give up equity when you're starting a company? So this is kind of a age-old question, because it's tough to really put a spot on when I should be giving up equity. But I think the way you should be looking at it is, or the way we should approach our business is that when we start driving our business out, the key is that you're de-risking it as much as possible. And my whole thing was, the more money you make other people, the more money you're going to make yourself, or the more sustainable your business is going to be. So you kind of have to support the ecosystem. So do I want to give everything away right away? No. But if I'm looking to hyper grow my business, I have to use something in order to get people to come in and support, from a senior level executive team to board of advisors. All of these little components are going to help you grow your business. It's going to help de-risk your business as much as possible. So the best position is to come in as strong as you possibly can. So if you have de-risked your business as much at the beginning, then when you start to give up equity, that equity is going to be coming out of your business when your business is doing well. And what I mean by doing well is that you've proven that you've got market fit, you've built a moat around your business, you have some form of IP, and your sales are growing. So your sales are probably, hopefully, when you start to look for funding, your post revenue, maybe doing 5 to 10,000 a month. Hopefully you're up in the hundreds of thousands a month if possible. But as you start to work your way through, you're going to start to see that you've got market fit. And when you have market fit and people start to buy, you now want to accelerate this to prevent other people from coming in and encroaching on your space. And that's where your IP and patents and things like that, they're going to support you. But now this is where you're going to need funding. Sometimes funding will occur pre-revenue. Your company might find market fit, but you haven't started to charge for that product. So now you're going to have to start looking at taking equity on the value you created. Maybe you've got a great system or a great product, you're going to market. So there's lots of different venues of how and where and when I'm going to raise funds. But you always have to keep in mind is that you need to have a strong value. And you'll know when you have that strong value because people will come knocking. Everybody wants a good value conversion. So you need to figure out what that line is that allows you to move forward. So if it's through revenues, it's through a great product, great service, figure out where that fits and then go and raise funds. And you can raise at $1 million and do something small, friends and family. You can do that on a safe if it's your very first round. And then you can work on your next round, your pre-seed round. And maybe in this pre-seed round, you're setting yourself up at 3 million because you've got maybe a couple thousand of MRR, which is your monthly reoccurring revenues, or perhaps it's higher than that, or maybe you're not even at that stage, but your planning stage has been growing, your systems are growing, and people are starting to see and feel that you have something here that's really solving a problem and it's going to be growing quickly. And they want to put their money in to help you accelerate that growth. And with that money comes obviously the great people that are going to be supporting you. And at that point, I always look at it as that if it's an early stage company, and if I have 5 great investors that come into my network, that's 5 new great people that can help coach me along the way, but they are also 5 great people that have networks that I can utilize to grow from. They can make connections for me. And these are the people that I think should be rewarded because they're the ones doing the best job to help you grow. Then you may do a seed round, and maybe at that point, in between, you do some sort of middle ground for maybe a couple $100,000 to get you to that seed round. And some of those can be done again just as convertible notes. They don't have to always be equity. You just have to look at what's going to bring you the best value to maintain the most ownership of your business throughout this process. The last thing you want to do is going into a Series A round owning 20% of your company. I would push against that 100%. If you're going to a Series A, you want to own as much as you can because as you grow and get bigger, you're diluting yourself. So try to maintain as much as you can. And that just all depends on those little steps that you're going to take as you grow.
How can a startup build traction with few resources? And would angels and VCs invest prior to traction?
Another great question. And yes, 100%, angel investors will always come in to a great problem solving business. 100%. It's also not so much just on the problem solving, it's on the owner of the company or owners. Because if you can help de-risk that business by taking care of those little pieces, investors will be more interested to come in. And angel investors want early stage investment. They want to be in first. They are the highest risk you can get. So you may find one-off angels, which is the best way to start. That gets put on your pitch deck and shows everybody that this person who angel invests has taken a risk and they've jumped in to support you. That's huge. That's a big de-risker. And now they're going to work with you to help you grow the business. From being able to get traction, being early on, it is a lot tougher. There's a lot of platforms, as we earlier discussed, where you can sell your products and services. You really do have to work to get into a few of those. There are people out there that will as well help early stage companies from marketing strategy to support, and they'll do some of this for equity in the business to come. So a lot of the times they'll put some hours in, and then when you do your first raise, they want to be supported that way. And again, you can find different ways to maneuver by paying them a little bit less money or providing them with some sort of ESOP, which is your employee shares program. There's little different ways that you can help get people to get you to those next stages. But just remember that that equity is very important to you and that you want to be giving up the least amount as you possibly can until you get to that stage where you're bringing in revenues and you've got more people interested. You have to protect your business to grow, and it's not about not giving any of it up. Find the right people that want to be part of what you're doing. One of the things that we found was that it's a two-way street. If someone wants to help you, see how much they're going to put in before you guys sign the paperwork. Are they just pushing you to take equity and walk away? And you can't trust everybody, but you have to trust your gut and use that to move you forward. So see how much they want to be in there. How much attention are they giving you? Are they chasing you to be part of your business, or are you chasing them? Make sure it's a two-way street. And then for that early stage traction, find a business that really can support you and understands what you're trying to do. Because at the end of the day, if you have them supporting your MVP, they're going to iterate, they're going to change, and they're going to maneuver with you as you go, and they're going to support you along the way because they see you solving a problem for them, which means you're probably saving them money, time, and effort. And all of those pieces are going to be fantastic as you grow your business. So the best way is build that MVP, your minimum viable product, get it to market right away. Who cares if it's a scrappy product, as long as it gets out in the market and starts testing. Have one or two clients test it and give you their feedback, bring on one or two more and have them test it, and slowly iterate, slowly iterate. Don't make this a science project of testing and breaking and testing and breaking. You want to be able to get out and sell. And when you start solving it for one or two businesses, you can use that to go out to other businesses, say, hey, I've got these guys working with me. They're big fans of what we're doing. And they're not the large brands. You can't go to a Walmart when you're just selling a loaf of bread. You've got to really build that up. So find a business that is 10, 20, 30, 40, 100 people and work your way through the system instead of trying to take down the big dogs where everybody's knocking on their doors. You're just going to waste a lot of time. But keep in mind, the big business wants to talk to you because big business also wants to know who's coming after them. And it might not be now, it might be in 3 to 5 years. But the thing is that they can start to build in measures to block you. So you have to keep in mind, I do not want to go and knock on every competitor or everybody that may take me out right away. I want to slowly go after those people or those businesses. So I need to go after the smaller companies that are more eager to find new revenue streams and allow you as a business to start to percolate inside of their business.
What's the difference between convertible notes and safes? What do angels usually go for and why?
So A lot of early stage companies, if you're doing a friends and family raise, as I previously mentioned, is that a lot of them will set up a safe. A safe comes with minimal regulations to this product. It's a very easy going template. You can find them pretty much anywhere online. Y Combinator, a bunch of them use it. And there's no real benefit to the investor for that. If something goes the wrong way, they don't receive any of the assets. The investor also doesn't have, or sorry, the startup also doesn't have to do any sort of real reporting. So there's a lot of mechanisms that are prevented in that process that enables an angel investor to have the upside or some mutual upside on the benefits. So most groups tend to fear safes. They don't tend to want to get into a safe or invest on them. But at the end of the day, it's early stage. If it is really early and you're just trying to get some people in, a safe is the best way because you know you're going to need to raise funds later. So anywhere I would say from in your first $1 million raise valuation, a safe isn't a bad thing to do. It gets you moving forward, especially if you're only in the ideation stage. As you move forward and get into your next round, a convertible note is a great way for you to make that next step into investment. A lot of companies will do either equity or convertible notes in their first round. So anywhere between, it could be anything up to $5 million valuation. They will do convertible notes, 20% discount, 8% interest. There's lots of different ways to look at that product. But again, it's a great position to offer that as well as your next stage. And then of course you have equity. And if you look at equity at the beginning, instead of a convertible note, just make sure that the people that you do bring in or the businesses that you bring in on that side, on the convertible note or equity, they're very similar products, is that you're getting the right people behind you. They're going to support you and help you grow. Again, as anything grows and as you build up funds, you dilute yourself as you go. But if you structure it properly and you have a great legal team behind you, they'll support you in that sense. And I do emphasize that early on, you do speak to a lot of early stage startup lawyers, like our partners like Miller Thompson. They are fantastic at making sure that you can maneuver through this because it's important for you as a business to grow.
Do angel level business mentors expect equity in exchange for their help?
Yes and no. I think sometimes it is structured that way. A lot of the times, as in the case of OPN, one of the things that we do is we try to help companies along the way with our LPs. And as we're helping them, the only thing we look for is that in time when they do raise funds, that we get the opportunity to work with them at that capacity because we want to be able to invest in their company early on. So there's some give and take. Other investors will look at, if I help, I'd like some sort of equity for my time. And there's nothing wrong with that as long as, again, you've tested the waters to make sure that they're equally interested in your business, that they're there to help you. So it's a two-way street. They're pushing you and you're pushing them.
Will angel investors invest in for-profit and not-profit social enterprises?
Predominantly, angel investors are structured where they are looking to help build economies. They're building business, which helps businesses grow. They're putting the risk in to support that. There are groups and groups of investors as well that will invest in non-for-profits as well. So there are both sides of the track. There are almost two separate investors though. They really do not cross paths as often as we would think or like, but most investors or VCs or angels will tend to focus on companies that are generating revenues and that can be sold, bought and sold through the M&A process. But there are groups of people, obviously in North America, around the world, that will also invest in social enterprise. And you do have to look for them. Again, just like you have to look for investors, there is a specific grouping of people that do that investment. But don't fear, they are out there and they do want to invest in you, and you do have to look for them. Just like any investor that you're looking for, your first investor is probably going to be your best investor because they're going to support you the most they can. So just make sure that you look for the right people to bring in at the right time.
For an upcoming prop tech startup, is it better to pitch to real estate tech investors for seed stage now, or is it better to pitch to them in 5 months when real estate market will be resumed so that I can aim for more money with a higher evaluation?
It's a good question. I think if you're back in the same position as before, you're trying to de-risk your business as much as possible. I think what you will do to start now is that you want to get in front of as many groups as you can and get a pulse for what they like about you and what they don't like about you. VCs might be tougher because VCs don't invest in companies until they're at a later stage. So you're probably looking at a 10 million plus valuation, unless it's a fund or early stage groupings where they're tended to invest more by angel groups. So if you are, then they will invest up to about 10 million. So in valuation, that is. So in prop tech or in any of the up and coming or areas that have been impacted, I think there's still opportunities, but you should be out pitching everybody you can, because you never know who that one person is that might catch your pitch and figure that you are going to be able to make this work and drive it forward. So, I think that that's very important, is that you have to get in front of as many people as you can. You can't rely on just one group, because if that doesn't work out or they decide not to make an investment, you could be stuck where you have no funding and you've been vetting with that one group for the last 4 or 5 months and you needed that funds to convert to move forward. And we've had that happen with a few companies over the years where they were just sitting on one group to invest in them and they pulled out at the last minute, and it created a catastrophe for them because those funds were needed in order to actually move the business forward. And they were in a position where they had less power to move forward. So in the end, my recommendation is that prop tech or not, try to get in front of as many companies as you can, as many investment communities as you can, because their feedback's valuable, but it also puts you in top of mind. And when they're in top of mind, as you continue to grow and get traction, more people will remember who you were and when they saw you 4 months ago, and they'll probably approaching you by wanting to invest at that point. So the more face time you can get, the better.
What is the best way to approach mentors if I don't know them?
It's a good question, because I've spent a lot of my time in my career, plus through investing, working with lots of different companies. And I think the way that a lot of the approach that they've come from is looking for a nugget of collaboration or a way that gets people connected. So I think you really have to dive into that person, look them up online, figure out what they're talking about socially, what is their background, what is their knowledge, and does it fit in a space that you think can benefit you? And when those people, when you feel they have a benefit and they can fit you, find a way to connect with them. And that could be anything from at an event, joining on a podcast. As an example, this was a few years ago, but I wanted to meet with a specific person. I thought they were fantastic, super knowledgeable. And that's all I went to this one conference for, and I dug right in. And when I got there, everything else didn't matter except for that one person that was speaking. I waited till the very end. I had that quick chance opportunity to come in and speak with them. And that's where I was able to jump in, ask a few questions, and show the knowledge of the space, but also show the knowledge that I knew about them and what they were passionate about. And then that person ended up becoming a friend, a colleague, and a mentor over the better part of the last 10 years. So I think at the end of the day, you have to find a way to connect with people and relate to them, but also then allowing you to share what you're working on so that those people feel just as comfortable and excited about what you're doing. Randomize and going to this top dog mentality and trying to find Elon Musk or someone to that effect that you think, or Gwyneth Paltrow, and saying, hey, can you be my mentor? You might be shooting a little bit too far because they may not be have as much free time or as much cycles to do that and offer the value you're looking for. But if you've got somebody, again, in a space that you're trying to be part of, finding somebody that's operating and as a director of marketing or VP of operations, whatever that might be. These people have a lot of knowledge and they're underutilized. Find somebody that's been through the ringer that gets it, and approach them and offer to take them for a coffee, offer them in the future, offer that. Currently now offer just to have a Skype call or a Zoom call and just share that you want to pick their brain for 30 minutes and then find ways to help them. I think helping people is going to help them feel the need to want to be part of what you're doing. And what I mean by helping them is maybe you've got a sales lead for them, or maybe you've got a company that would really benefit their networks. Find ways to bring value.
Are there legal templates for funding documents available online?
Yes, there are. I'm going to think now, I believe the BDC has them. There's a group out of the US that supports them, supports these types as well. There is one group, oh man, I'll have to post it later. I'm just trying to think of it. It's the Ontario, it's a government site, and they provide a lot of this documentation as well. One thing you can look at again is if you're looking to vet templates, feel free to reach out to Laura. We can provide you guys with some background on different types of products you can go for. And of course, we have our partners on the Miller Thomson side, and they're fantastic at supporting this as well. And you do got to find different ways to be cost effective when you're looking for these templates. Once you fill them out, get them vetted again, because you want to protect yourself for sure.
The most common question I get asked is, what makes your product so unique? Can it be copied? I find that hard to answer because anybody can copy anything nowadays. Thoughts on how to answer that?
For sure. Well, the most common way to say is that you probably want to throw at that you have some sort of patent pending, or that you've created a patent around your tech or your service or your business. Those are always ways to keep the conversation moving forward. The uniqueness side of it is that it's how you approach a market, and it's looking at what are you doing different that other people aren't. What's going to attract attention? Because the key to being unique is that you attract attention. If you're not unique and you're the same as everybody else, creating the same pair of pants and the same styles, is that unless you've got massive exposure or volume, you become just another producer, and people find that hard to get behind if there isn't something unique and different about you or about your business. So find what that is. And if there isn't anything unique about it, then find ways to get into the market and penetrate that market to get the most value out. Because at the end of the day, not everybody's doing the best job at acquiring sales. And if you're great at sales, selling the same product, then prove it that way. Show the numbers, show the volume. There's a lot of different ways statistically and numbers that can prop up what you're doing that makes you unique over everybody else, because you're showing that other people aren't making the traction that you are.
What is the simplest cost-effective way to structure equity for an advisor early on if you are trying to avoid spending too much on legal to give away a small percentage without having cash come in for that equity?
You can set them up. The easiest, fastest way is just to set them up on your board. So you can create a small board of advisors, and you can provide them with a 1 year or a 2 year contract, if you will, and it would provide them with probably 1% broken out over 3 years or 2 years or 1 year. It's an earnout. That's one way to do this. There's no reason for you, unless they're coming in as a co-founder, for you to be providing large amounts of equity for somebody that's coming in to help you. But I think if you value out right away that person and what they're going to be doing, and what I mean by that is saying that that person has allocated 20 hours a week for the next 6 months to helping you, that's a whole lot different than 1 hour a month. So you have to decide what is the value that they're going to bring, how much time are they going to be putting into this to help you. And if they are coming in at a larger amount, then that's a big difference for how you're going to be remunerating that person, because at the end of the day, they're putting in more time. They're helping you out significantly. If they're coming on as an advisor, that's usually, maybe 5 hours a month of time versus 20 hours a week. So You're going to have to spend some dollars on a contract that's going to stipulate what they're doing and what they're getting out of this. But this also protects you, because as your business takes off, the last thing you want to find out is that this person stops working and then you have given away 10% of your company. Other options is that if somebody is that interested in your business, you're looking for investors, perhaps that person can put $5,000 into the business to help you grow the business. And then you look at different ways to give them that equity, again, in small amounts that are earned out over time.
Assuming my advisor is making helpful introductions but not rolling up their sleeves, how much is too much equity to give to that advisor?
Again, base that on the hours. How much time is the advisor putting in? Like anything, if you're putting in 80 hours a week, you want to make sure that the other person that you're working with, if she or he is putting in 5, 10, 15, 20 hours, is that put a projection together. How much time will they be putting in? And how much can they sustain themselves in putting in this time over the next 6 to 12 months or 3 months, whatever that might be. So if you're going to put in, if they're going to put in 20 hours a week for 3 months, and then you know that contract's going to end, but that valuable time and effort that they're using is going to be huge, figure out what that amount is, and then put that amount against what you feel the company's worth. So let's just say that that time is $10,000 and you feel your company's now worth $1 million. Well, they're spending $10,000, so you shouldn't be giving them more than less than 1%. So just work out the angles and forward think to protect yourself, because there's so many times I see where people have come in, worked a few hours, and they own 5% of a company when they've not brought any value. So just protect yourself. And again, have a look at how, on a legal side, how you can manage that. But also you want people on your team that are going to invest and put their time and money in behind you, because that de-risks your business and it looks great when you have people that are also invested in your company that are working with you.
Regulated equity crowdfunding in Ontario is fairly new. Good for startups, investors, or will it be a flop?
It's a good question. There's a lot coming out right now on equity crowdfunding. There's a few different companies. Just like anything from accelerators, incubators, all of these facets, VCs, angels, BDC, everybody brings a value to your business. All of them do. And they're all great ways and avenues for you to grow your business, take investment, and move things forward. So I believe equity funding or crowdfunding resources, I think they're great. And again, are they getting quick money and do they solve the problem you're looking for, as long as you can balance out how much equity you're giving away and making sure that, again, it's money. You're not going to be bringing in this component as being people that are going to be supporting your initiatives or being on your team. It's just funding. So earlier on, as long as you can manage what equity you're giving away, it's another funding source. So are they going to go by the way of the dodo, as the saying is? That I can't predict, but I can say that in the times that we're in right now, people are going to be either heavily looking for funding, or people are going to be looking to invest in more, put money into these platforms so that they can find faster, quicker ways in the future for some of these companies to grow and they can cash out on them. So there is risk on both parties. Is it a value for you guys to look at this as an avenue? I do think it is, but again, you have to figure out in your life cycle where it fits in and the value that it fits in for you.
Is it true that a private Canadian company is only allowed to have 50 shareholders in total?
Yes. Before you need to become an exempt market dealer, if you are, it depends, because again, there's different ways of doing this. There's a couple of different positions for that, and we can provide that breakout for you, because once you become, as you move forward, you're trying to keep your cap table to as minimal amount of investors as possible. And there is a minimum set. I believe they were working on changing that number, but I can get more information for that and share that later.
What's the #1 motivator for an angel to write a check right now?
What is the motivation? Because of the changes in the environment, I think the key to making your business viable is not just viable for now, it's also viable in the future. And right now, the future is unpredictable. Nobody will understand where we're going to net out. Are we going to be all working from home going forward? Or business is going to go, everything going to go back to normal? So I think for investors on how and where they want to invest, they have to invest on companies that will grow through this pandemic and be able to support themselves going into the future. So not just a one-time shot that their company comes in now, lasts 3 months, and then once the society goes back to normal, that company fails. Or that the company comes in now and can't survive 2 years. You kind of have to look at a business from what they're able to do now, where they're at, and there's going to be a lot of new companies that are going to pop up because now people will be coming up with different ideas on how to cope and change in this environment. And those are going to be the newest types of investments. And those will come through over the next 3 to 6 months. And you're going to see a whole new environment of startups. So for existing companies, a lot of them are pivoting to shift to be able to adapt to support in this environment and then grow from there. So companies and investors are going to be looking at how fast you were able to shift, what you were looking for, and will this be a business that's going to be sustainable in the next 1 to 2 years. And the difference between the financial in 2008 versus today is that nobody predicted that they would have to be looking at companies that couldn't survive through home lockdown versus companies that were going through financial turmoil, and that the environment was still able to sell on the street and sell in other areas. So now everything has become a bit more digitized. So you kind of have to start looking at companies that can sustain any sort of change in the environment. And that's going to be a tough one. So investors will probably at this point in time start to tighten the belt on how they do that.
Have investors increased their interest in the education sector?
I would say that currently, yes, there have been over the last 2 years, quite a few education startups that have come into the space, because it has been a very tough space in general to crack getting into education, because they have been set up as more old school style businesses. But predominantly in the last year, and especially in the last few months, you've seen the educators space change dramatically. And because of those shifts, everybody going to using Zoom and participating in more digital platforms, I think you're going to see a big upheaval in education space. So it's certainly well worth diving into this space. And there are, like I said, there are a lot of new products coming out, but people are predicting that there's going to be more schools educating at home now than there will be in the office space or school business space.
Sorry, was muted. We're approaching 11, so let's one more. Should I build a company now during all of this?
Laura, why don't you take a crack at that question and then I'll jump in after.
Really? Now is a good time to build a company because you have more time for planning and strategy. You have a lot of people that you wouldn't be able to talk to are available now.
And that's brilliant. And I completely agree with you. And I created this little basic startup basics just so that everybody could have a quick look. But Laura, you're bang on that one. And what I would like to share is that there's different ways to look at your startup, but currently right now, there is a huge opportunity for people to start exploring and looking at creating their own business. And sometimes they become side hustles and sometimes they grow to be something bigger. It's all your mindset on where you want to go. If you already have a current business, you're probably looking at pivoting. So you got to find value to grow, shift quickly and iterate, and then rinse and repeat and keep trying that process because you have to correct yourself in order to find market fit. You mentioned strategy. So plan where you want to be, work the plan, make it a micro plan. And then every 3 months, you're going to shift that plan. But monthly, you're going to do intervals and you're going to start looking at, you're You're going to start looking at crawl, walk, run. So what do I need to do just to move a little bit? What do I need to do a little bit more? And those types of strategy and planning is going to help you succeed. We talked about it a bunch of times, mentioned on de-risk. Everything you do now in a small business to move forward, to get investment, is about de-risking your position. Reducing your monthly burn, find products that are going to support what you're doing to make things smoother and faster. Find a unique solution, define your problem, and make it a winning position. And the best way that I describe this is the other day I was out for a run and it kind of popped in my head, and I look at your minimal viable product. And when you're going to market, picture yourself trail running. And I'm sure lots of you have gone through trails and run. Well, when you're going on trails, there's always intersections that come across as you're on your trail run. So you can turn left, you can turn right, you can go straight. All of these different avenues are faced in front of you when you're running or you're walking a trail. But the end goal is that you want to climb that mountain. And for me, I love climbing mountains. But there's one thing you'll know about mountains is that as you start climbing them, there's only one trail, maybe two. But you're going to learn that right from the beginning, is that there's one way to the top. But the thing is that you've got to work your way through all the mazes and all the different channels at the bottom of the hill, because that's going to refine your process, get you sharper. You're going to find the right people to work with. And when you get to that mountain, you know that there's one path that's going to take you to the top. And it's the easiest set path that you got to focus on. And that is what focus is. So at the beginning, you're going to be faced with so many different pieces coming in front of you. And you're going to pick the right trails that are going to get you to the base of the mountain. And then from there, that's where you're going to take off. And that's where investors want to come in. Early stage, they're going to find you along that journey, along the trails. But then as soon as you get to the mountain, that's where everybody wants on board, because you found market fit, you found where you're going to go, and now the direction is up. And you're going to take that trail and make your way up the mountain. So all of those things are all different ways to adjust and look at your business. But I think the key to all of this is to keep a sound mind and build a process, build a strategy, de-risk your business as much as you can, find that minimal viable product and get it to market as fast as you can. So in saying that, we're at 11 o'clock and I want to thank everybody that joined us today. We had close to 60 people that came onto the panel. Fantastic. Very excited that we were able to share all of this, and being the first time on the hot seat, hopefully I was able to provide you guys all with some great insights. Next Supporters Fund, E2E is on Thursday from 10:30 to 11:30. We hope you guys can join us. There'll be 20 great startups that will be giving feedback. And in 2 weeks, when we do our next Ask an Angel, we'll be doing something even cooler. So feel free to join us. If you have any questions, send us an email, add us on LinkedIn. But I thank you very much, everybody, for joining us. You guys were great. Thank you for all the questions. And we will post some other information around the questions that we weren't able to get to. But thank you. It was great chatting with everybody. And have a fantastic day. Stay positive, keep smiling. And at the end of the day, be happy. That's the best. All right, guys. Thank you very much. Laura, thank you very much for your help. And we'll keep tying you in more and getting all that great insights from all you guys. Thank you.